HIMS House, episode 28. I'm Jonathan Stern. I'm here today with Alvan Chow, the original WallStreetBets poster who made a 100,000% return on the GameStop short squeeze in January 2021. Of course, during that time, GameStop rose from roughly $17 a share at the beginning of the month to nearly $500 at the top of the squeeze. An episode since described as one of the most significant events in modern financial history for how it's reshaped the power dynamics between retail and institutional investors. Given that HIMS short interest has been climbing for months and months and recently hit an all-time high, I wanted to have Alvan on the show to discuss what he learned in 2021, what short squeezes look like under the hood, and then any similarities, if there are any, between HIMS and GameStop. Alvan, welcome to HIMS House.
Thanks, Jonathan. Been a HIMS House member for quite a while, a HIMS hero, and it's amazing to see how far you've taken this community.
Well, thanks. We're certainly excited to have you on. I want the first part of this interview to explore the GameStop saga, sort of as context for going into HIMS. And then maybe let's get into your origin story a bit as well. So can you take us back to 2020 or 2021? Would love to hear what got you interested in GameStop in the first place.
Yeah, so I've always been sort of looking for asymmetric opportunities because if you compound, 10, 15%, but you only have like 10,000, that doesn't really take you far. But it was Michael Burry who first sort of flagged GameStop, I think for a lot of people. He had it in his filings, and he mentioned that every store was actually free cash flow positive, which was basically a sign that it wasn't going to go bankrupt anytime soon. Then the super interesting thing was that it was extremely heavily shorted. So the short interest at the time was over, I think, 138% of the free float, which just mathematically is kind of crazy. So I looked at previous examples of what happens when you short over 100% of the float. There weren't many examples. The two main ones, actually, the first one was Volkswagen, which was a very short-lived sort of squeeze and very limited amount of traders involved anyways. And that actually the other one was KBIO with Martin Shkreli, who you interviewed not too long ago. So I don't think he talked about that, but
yeah, Martin interesting to see KBIO, unfortunately.
Yeah. So he's familiar with this with these kind of things. But yeah, so then I started to do more research. At that time, WallStreetBets, it was actually a sort of like a like a joke community. It was very small, and actually the sort of running joke actually was that everyone always continuously lost money. So you'd always post like your losses, and those would be the most upvoted things on WallStreetBets. So I was like, okay, this community is giving me a lot of entertainment and education, and why don't I propose something that maybe you can't lose? So at least it's like a double, maybe more, and it turned out to be just an incredible story.
I'm so intrigued by the fact that more than 100% of the float was short with GameStop. Like, can you go through the mechanics for how that could happen?
Yeah, that's right. So these are all sort of second-hand sort of accounts that I find and I look up. It's hard to really know exactly what happened, but effectively, and I think this was Chamath's recounting of the tale, you have hedge funds on Wall Street that are long and short. So they buy positions, they short positions, and Melvin Capital was at the top of the pecking order. They're very, very good. They actually are extremely good. That's right. So they made a lot of money for a long time, and they were short GameStop. So what happens is you have a lot of copycat funds that tail that position for, who knows how they figure out what other people hold. You borrow the available shares, and then you short it, and you hold that position. And I didn't understand actually how it could be above 100 100% of the float. So I tried to look at historical examples, and it was very, very limited. And obviously, it's not a smart thing to do when you're overly shorting a certain company.
Got it. So, all right. So let's go back to 2021 then. I'd love to understand your psychology as you went long GameStop. Were you thinking about a squeeze, or were you just attracted to the fundamentals of the stock? I'd be curious to hear, like, what sort of odds did you give it at the time that a serious squeeze might actually happen?
Yeah, I think you sort of have the fundamentals of the company as a margin of safety. And so that's sort of your I don't want to say a hedge, but in case the trading goes way too volatile and you don't know what's going on, you can kind of estimate a fair market value for this company based on its future cash flows. Okay, so that's how you originally look at the GameStop thesis, is that it's trading way below, its cash balance and what you think it should be trading at. Then you have the sort of short term, you know, trading market mechanics, options positioning, short interest, probably the main two, retail sentiment, institutional interest, and those can add a lot of fluctuation. So in my view, I think it was trading under what it should be by about 50%. So that was my original interest. But past that, it's you're looking at momentum, you're looking at different trading patterns, Fibonacci, whatever. Everyone's posting stuff online, and you can sort of estimate, and a lot of it's intuition, really. When do you think this thing is going to hit peak sentiment, right? So when Elon Musk and politicians are posting about it, okay, that's probably as far as it's going to get, and you should probably start to take some profit. So if I draw the corollary to HIMS, it's that this company has very strong fundamentals from what I see, right? Currently, they've been growing free cash flow for about, like, I think, the past 8 quarters, growing revenue, and we'll see what happens next Monday with the earnings, but that can sort of be your margin of safety with respect to the short term, extreme volatile swings that you'll see from shorts covering or sort of retail, frenzy buying. That's going to be a little bit harder to navigate, and it'd be wise to take profits whenever you can.
So I guess I would like to understand, though, when you took your position in GameStop, were you expecting, 20% over 6 months, 100% over 6 months? Did you ever think, on account of the short interest, which was extraordinary, right? Over 100%, that you might see like a 25x in the share price in a short period of time?
Yeah. So I think no. In the beginning, obviously, it was impossible to predict. I thought the sort of the most euphoric it would be like Jim Cramer or Josh Brown talking about it. I would never expect it to be like a household name, right? I thought it would sort of stay within the realm of Wall Street and finance. So yeah, but the narrative changes every day. You have a live streamer going on YouTube, with a very charismatic persona,
Are you
similar to
referring
Jonathan
to
Stern.
the kitty?
Yeah,
Is this
yeah,
kitty, the roaring kitty? Yeah.
yeah, roaring kitty. So
I wanted
real
to
life
ask you.
roaring kitty
I wanted to
for
ask you,
him.
actually, have you met or interacted with or talked to Roaring Kitty online at all?
I've never interacted with him other than his YouTube stream. Maybe he has like anonymous stuff, but he's very, very tight about that. So who knows why? So yeah, so you have a YouTube channel specifically talking about a certain stock, and then it keeps evolving. There Before the split, I kind of just made a joke on the post. I thought the stock would go to 420, and it eventually hit that, and so that was crazy. But you know that kind of return, it's impossible to predict. I think you just have to watch it day by day, and see how things are developing.
Okay, so I want to transition, I guess, to what a short squeeze is from a technical standpoint. Maybe it's worth starting with setting a foundation. Like what is short selling? Lay that foundation, and then we'll get into the deeper stuff.
Sure. Yeah. So short selling is when you have a negative outlook on a stock and you hope the price will go down. So you borrow shares on the open market and you sell them before you even own them. And so let's say you borrow a share at 10, the stock goes down to 5, you buy it back at 5, you've made $5 in profits. But the mechanics of the trading is reversed. So typically you buy a stock and then you sell it. This time you're selling it and then buying it. Or you can just sort of, you know, mathematically directionally short it by buying puts. And so, you have a strike price that you think the price will go to. If it dips below that, then you're good to go by the expiration date. What was the other question?
No, so that's great, and that's why it's called short selling. Next question is, from a technical standpoint, how should we think about the difference between, say, a stock going up 20% because fundamentals are improving, and a stock going up 20%, I don't know, like overnight as a result of a short squeeze?
Yeah, I think the tough part is you actually can't really tell. So it's just going to look like buying. I remember when we were doing the GameStop thing and in Discords and Twitter and Reddit and all that, people were watching like overnight markets in Germany or Korea or whatever and seeing GameStop trade there before the market opened in America. So you can kind of use those things as proxy if things are getting super crazy. But for the most part, it's just going to look like buying, really. And so it's going to be very hard to tell. You can use ortex.com try to guesstimate. They have their own sort of proprietary metric of measuring short interest live. But other than that, you're gonna have to really wait for the official short reports that come out every 2 weeks, 2 weeks from the market. There's no really other way to tell.
Right, and so it's the New York Stock Exchange that has this bi-weekly cadence of
Right.
releasing short interest, and
That they're 2 weeks delayed, right? So it's very pretty bad data.
yeah, it's usually like 10 days delayed by the time that the new data comes out. And so, like on HIMS House, we just reported that there are 60 million shares currently short. That's like 33% of the float. The unfortunate thing is that that data is as of like April 15th. So we have
Hmm.
no idea what we're recording.
Yeah.
It's April 30th. That data
Right.
is now 15 days delayed.
Yeah. Exactly.
We'll of course get updated data, next week, but well, may actually be another 10 days. But in any case, you're exactly right that the data is delayed. There are some signals though that people use to sort of try to track short interest in real time. Like, do you pay any attention to, I think on Fintel you can see the available shares to short, or
Yeah.
borrow rates or anything like that?
Yeah, there's a couple. You can use Pentel. You can use iBorrowDesk, which borrows from interactive brokers. You can use fail to delivers too, which are these sort of official numbers. Those are if the shorts need to return their shares back and they haven't. It's I think in general these things should be directional, not very specific. And yeah, there probably should be more transparency on these things, but there really isn't. So if you are hell bent on getting sort of live approximations, probably the best thing to do would be the borrow fee. I think that's most indicative of the demand to sell short. And so once those things start to relieve pressure, you can safely assume that there's been a lot of covering.
Great. And I sort of referenced this with the intro, but there was such an a retail versus institutional power struggle 4 years ago with GameStop. I mean, that was one of the major storylines. Curious to hear, like with most short squeezes, how important is retail? How important are the institutions? Can you give us a breakdown of each?
I think retail is faster at obtaining sort of the view, but they are much less powerful. So the retail can really only sustain buying for a very short period. You really need that sort of institutional backing for these things to work. And I've tried to trade a couple of these highly shorted names besides HIMS and GameStop, and that seems to me to be the case. That retail, it doesn't really have that much power. Although I would say they're much quicker at analyzing things, putting stuff out there, talking to people, getting consensus, because everything's public and there's very low friction. Yeah.
And then final question on the technical stuff. Like if you were to, let's say a squeeze is happening, how could people take advantage of that? Should they go long the stock? Should they buy options?
Yeah. I mean, my strategy is, I'll have this specific price target that I'm aiming for the stock to get at. And then once it reaches that point, I'll take a significant amount of profit, maybe 80%. And then the rest of the 20%, I just throw into like extremely out of the money call options, just for like FOMO hedge, basically. So if it keeps running, I'm happy. If it goes to zero, whatever, I'm an 80% profit. So that's typically how I try to do things. When it squeezed last month, I used that strategy and it paid off pretty well because it just kept going up. Yeah. And so if we look at HIMS, last month there was a mini squeeze, basically. Went from I think like 58 million to 46 million shares short, so around 12 million reduction. That led to around 100% increase in the price. But it's since then added all the shorts back. So we're now, as you said, back at the all-time high level of short interest. And so, I guess the fundamentals have been less favorable because the licensing from Novo Nordisk is not as good as just straight selling the compounded GLPs, I guess, is what people are saying with respect to margin. But yeah, we're back at 60 million. So that's I don't know why they would pick this stock to short. Wouldn't you want to short something that's like, it's like declining revenue, declining EPS, declining free cash flow? Like why would you pick something else? That's just kind of boggles my mind.
Yeah, I mean, as Martin Shkreli said, like it's hard to find a worse stock to short, a stock that has had, 8 straight quarters of positive free cash flow, revenue that's just booming quarter after quarter after quarter, a management team that has beaten on revenue and earnings and raises guidance, I think just about every quarter since the company has been public. And yet we have a short interest that is higher than any other company on the S&P midcap 400. No hypotheses as to why. I mean, there's litigation risk, or there was. Like, I think what Martin Shkreli said is that we had a situation that was going from great to good potentially, but like in my mind, I don't know that merits 33% short interest.
Yeah, if I just, I have no idea what the shorts thesis are, and I think the prudent thing to do would be to assume that they're correct, actually, right? So what are they seeing that we're missing as longs? I think that's the correct stance, and to continuously look out for this deceleration or whatever their thesis is. But when I speak to just sort of normal sort of medical care providers, their view on HIMS and that they're not really sort of market participants. They just don't think that they're like, HIMS, why would you buy something that has a markup, right? You can just go to CVS or whatever and buy the same thing. So that's kind of just the normal pushback against it. On the other hand, it's you build that relationship with the customer. It's trusted. They haven't had any sort of big scandal so far, which is very important. I think that would be very bad if HIMS has sort of like a Chipotle E. coli moment where something really bad happens to their patients. That could be a proper short thesis, but it hasn't happened yet. And if shorts want to play some game and make interview someone fake to push this out. They may try to do that.
Okay, so we're sitting here on April 30th. As we've said, the latest data suggests 60 million shares are short. It's like 33% of the float. Can you walk us through like what might happen from a numbers perspective? Where I think we just closed at $33 a share. So let's fast forward 2 weeks. We're gonna have earnings on Monday. Let's say there's really good news, or the company is just as solid as can be, and we have a squeeze. Let's say we have a squeeze part 2.
Yeah.
What does that look like this time, given that 60 million shares are short?
Yeah, that's a really good question. So a lot of people, I just go back to GameStop for a quick second. They focus on the original short squeeze that got a lot of media attention, but there was actually a second one. And that one was when the short interest was already kind of depleted, around 20 and 30%. And that one still had a 10x, just randomly. It was very, very quiet. Nobody talked about it. Went from like 30 to 300. And then it fell back down, obviously, to where it's trading at kind of around now. I suspect that my sort of guess and my bias would be that the second squeeze for HIMS would probably be more in magnitude than the first one. If I see it go 5 or 8 times, that's probably okay. The squeeze is over. The reason is,
If HIMS has an 8x,
yeah, if HIMS has an 8x. Obviously, it depends on what's your position, right? Like how short dated is your call, how long dated is. If it's short dated, just take the profit, right? Don't worry about all that stuff. Yeah, but if it's my guess is that the second one will be more in magnitude. It'll sustain the level. It'll probably be more take longer because they see this position they have, the shorts. I mean, I'm just trying to estimate their psychology. They're wrong for a little bit, but then they were proven right because the compounding needed to stop, and now they're kind of wrong again, maybe. But this time it's a more lasting partnership. So yeah, I think if Andrew can continue to execute, continue to sustain and raise guidance, I think the second one will be much more violent and much more profitable for the longs.
One of the things about short squeezes that's so interesting to me is that you have cases of stocks going up, as you said, 8x, sometimes overnight or over a short period. And yet, oftentimes, very little has changed about the business from a fundamental perspective. Maybe it was already in decent shape before the squeeze, but it's often not like it's not earnings or any fundamental news event that triggers the squeeze. Is that right? Is it like would you call it a technical move, or does it need a fundamental catalyst to really get going?
I think what's the safest thing to do, obviously you're risk on, you're long, but the sort of the best practice in my view is to you pick a valuation that you think the company deserves, okay, and then you set whatever is the analogous price target, and then you just bet on that. So whatever happens in between, that's the volatility that you have to stomach. So if it goes way past your price target, you got to be okay with the FOMO. If it dips below, are you wrong or are you gonna, or are you right and you should buy the dip? So that's the kind of thing. And then eventually, if you're correct, it should even out to where the proper sort of all these things are just opinions and subjective, but your proper valuation of what you think the company is worth. So I think the best corollary to HIMS is not so much GameStop, but more like Tesla, more like Palantir from last year in 2020, sort of Tesla 2019 to 2020. They also had around like a 30% short interest, and then the stock just rocketed. The price action itself drives attention, drives what you really want is more interested longs. You don't really care too much about the shorts, because once they disappear, the price is going to fall back, right? So you need the longs to sustain the price.
Right. And in the case of GameStop, I guess it did fall all the way back
Right.
because there weren't enough longs. But you're likening HIMS more to Tesla or Palantir because while there was 25, 30% short interest, enough longs came in to sort of buttress the price once it did get to elevated levels. Is that
That's
right?
right. That's right. Yeah. So yeah, if your thesis is solely short interest, that's going to be you're going to be just eyes glued to the screen trading this until the market closes. It's and people do that very successfully, by the way. But I think what's easier, I guess, maybe for most people is you have this sort of fair market valuation. That's your margin of safety, and the price sort of takes the pathway to get there, and then you can have fun along the way. But I think it's a more solid sort of thesis, and the company is performing very well.
Can you talk about what sort of effect a short squeeze has on the stock, the company, maybe even the shareholders over the long term? Like looking fast forward 2 years, 3 years, 4 years for GameStop, for Tesla, for Palantir, for any of these companies that we've talked about. What's the lasting effect?
Yeah, I think more and more people are online. They are trading individual stocks. It's just free commission. There's a lot more resources and material online. And so I think price action drives a lot of interest. It's like almost free marketing in a way. And if it gets really crazy, like in the example of, GameStop and Tesla and kind of Palantir, it's like you get free customers. And this can be international too. I remember in Tesla, when Tesla was squeezing, there's like Korean traders like bidding on this thing. And it's because they would post on WallStreetBets and everything would be in Korean. You're like, what the heck? This is international now. So just like, and expand the scope out of America. This can go like even, this can go global if it gets really crazy. Obviously, you don't want to bet on those, extreme tail events for your trade to work out, but it drives attention, and a good management team would take advantage of that, right? So I think one pretty bullish thing that happened in the last squeeze is Andrew didn't dilute. So, you know, I don't know if it's, there was some restriction or whatever, but he didn't dilute, and that's a pretty good thing.
You're saying the company didn't have a share offering at the near the peak?
Right. Yeah. Yeah. Because sort of when you're holding these call options, let's say the stock is squeezing like 20-30% after hours. Sometimes the next morning, boom, they dilute you and you're down, 99%. So that's the things you gotta be careful, right? It's good for the company, but obviously horrible for your trading positions.
I'm so fascinated by the Koreans because in the Discord, in the HIMS House Discord, there was a little bit of chatter recently about the importance of retail investors in Korea. Apparently all of this data is public there in a way that it's not here. And so you can see like top stocks owned by retail investors in Korea. And it's like, I don't know how often it's updated, but I think HIMS was not yet on the leaderboard or near the top of the leaderboard. And I, to what, like, what do you know about retail investing in Korea? Are you able to say a little bit more about that?
Yeah, that's interesting. I didn't know they had the special data. I know that they are pretty big on crypto before it went mainstream, and this is just just from people I talk to, but a lot of them view trading as a way to escape the sort of normal lifestyle, because it's very hard to win in Korea, South Korea, as a young person. There's population sort of headwinds, and it's just it's like the 9 to 5 corporate America, but on super steroids. So they use alternative methods to try to escape that wheelhouse, and that's the story for a lot of people. So that kind of explains why there's sort of Korea is like an outlier, I guess. But yeah, when the Koreans come, that's I don't want to say you want to sell into that, but that's a euphoric signal, right? So if the fundamentals are not there to back it up, that's probably a sign for you to do something.
But you're saying like if the Koreans catch wind of HIMS and it becomes extremely popular over there, are you saying that would be a time to sell or to buy?
Well, I think you need to look at the
Like any of this doesn't really affect the fundamentals, which is honestly, I think what you're saying more than anything, which is that the fundamentals matter most. But would retail buying in Korea be a top signal or an
I
indication
think
that we're going like much, much higher?
yeah. I think no, I don't want to use them as extra liquidity. Of course not. I think if the fundamentals change and the Koreans pick up on it, okay, yeah, it's game time. If it's just like out of nowhere and people are posting like I made this much money and they're screenshotting it, okay, that's probably a top signal.
Sure. In a few recent videos, I've been asked to ask some guests who are bullish on HIMS, how bullish? If you're comfortable sharing at any given time, like how many stocks do you own? What's your concentration level and where does HIMS rank relative to your other positions?
Yeah, yeah. I have a I have a lot of different things going on, but I think him's probably, I would say 20 billion seems like a very reasonable valuation to me. So that's going to be my sort of near term target. It should, climb to there is my bias. After that, we'll see what the fundamentals look like. Is the growth continue to accelerate even, or are there going to be some massive macro headwinds that impede its growth? So I'd say around 20 billion, and then after that, 20 billion would be already pretty rich in my opinion. And then after that, we'll see what happens.
Got it. So that's close to 3x from here.
Yeah.
Are you able to share what percentage of the portfolio you have in HIMS or how you think about it relative to other opportunities in the market?
I don't just have like one portfolio, so it's kind of hard to say, but it is a top position.
One of your top positions? Okay. Cool. Well, this has been episode 28 of HIMS House. Alvan Chow, thank you so much for taking the time.
Cool. Thanks, Jonathan.